Here is something that would make a modern loan officer deeply uncomfortable. For most of American history, there was no universal three-digit credit score. No number followed you from bank to bank. No app could tell you that your financial reputation had risen 12 points. No automated system could reduce years of borrowing, paying, missing, saving, and struggling into a figure between 300 and 850. And yet people bought furniture on time, opened store accounts, financed automobiles, borrowed for homes, and ran businesses on credit. So how did a lender decide who was trustworthy before the modern credit score existed? The answer was more personal, more local, and often far more intrusive than the system we know today. Credit is older than the United States. It begins wherever one person gives something now in exchange for a promise of payment later. A farmer takes seed in the spring and pays after the harvest. A shopkeeper allows a familiar family to carry a balance until payday. A merchant ships goods to another merchant whose reputation is known through letters and mutual acquaintances. In each case, the transaction depends on information. The lender wants to know whether the borrower can pay, whether the borrower will pay, and what can be taken if the promise is broken. Before national databases, most of that information lived close to home. A country store owner knew who worked steadily, whose crops had failed, which families paid after harvest, and which customers had moved away, leaving debts behind. The ledger behind the counter was not merely a list of purchases. It was a map of local trust. A good reputation could open an account without a formal application. A bad reputation could close every door in a small town because the same few people controlled most available credit. This local system had one obvious strength. Human beings could understand circumstances that a formula might miss. A merchant who knew a family could extend extra time after an illness or a poor harvest. A banker could judge the prospects of a business that had no long financial record. Character, relationships, and community knowledge could support borrowers who looked risky on paper, but the same system had a darker side. Personal knowledge could become personal prejudice. A lender might judge a borrower by religion, neighborhood, accent, race, marital status, gender, or family name. There was no transparent score to challenge because there was often no written rule at all. Approval could depend on whether the banker considered someone respectable, whether a merchant liked a person's relatives, or whether a credit reporter described the household in flattering language. As the 19th century economy expanded, local memory could no longer carry the entire system. A wholesaler in New York might receive an order from a merchant hundreds of miles away. The seller could not ask a neighbor whether that merchant paid bills on time. Railroads, telegraphs, and national markets created more opportunities to lend, but they also separated lenders from the people asking for credit. The information problem became a business opportunity. Commercial credit reporting firms emerged to solve it. One of the most important early organizations grew from the Mercantile Agency, founded by Louis Tappan in 1841. It gathered reports on businesses through a network of correspondents. Another firm founded by John Bradstreet developed a competing service. The two would eventually combine into Dun & Bradstreet. Their reports helped merchants decide whether distant businesses deserved credit. These early reports were not three-digit scores in the modern sense. They were narratives. A correspondent might describe a business owner's property, habits, associates, debts, and standing in the community. The report could include hard financial facts, but it could also include rumors and moral judgments. A person's private life became evidence because lenders believed character predicted repayment. That assumption made credit reporting extraordinarily invasive. Investigators asked neighbors, employers, and business contacts for information. They wanted to know whether a person was sober, industrious, and respectable. They recorded marital situations, lawsuits, illnesses, and perceived weaknesses. The borrower often had little opportunity to inspect the file, correct an error, or learn why credit had been denied. The system expanded from commercial borrowers to ordinary consumers. By the late 19th and early 20th centuries, department stores, finance companies, and local credit bureaus were collecting information on household accounts. Urbanization made informal trust more difficult. Millions of people lived among strangers, changed jobs, rented apartments, and shopped at businesses where the owner did not know them personally. Retail installment credit filled the gap between wages and the cost of newly available goods. Buying on time became central to the consumer economy. Sewing machines, furniture, pianos, and later automobiles and appliances could be purchased through installment plans. The seller did not only need to know whether a customer had money today, the seller needed to estimate whether the customer would keep paying for months or years. Every new installment account produced information, and every piece of information could influence the next decision. Local credit bureaus began sharing records among merchants. A customer who failed to pay one store might find that another store already knew. This reduced some forms of fraud and allowed businesses to lend to more strangers. It also created a private information network with enormous power over everyday life. The borrower's financial identity was becoming portable, but the rules governing that identity remained inconsistent. Credit managers tried to make judgment more systematic. They developed rating sheets and point systems based on income, occupation, years at an address, home ownership, savings, and payment history. These methods were early forms of credit scoring, even though they were not the national consumer scores familiar today. A lender might assign points to a stable job and subtract points for frequent moves. The result looked objective because it involved arithmetic. The categories themselves were still chosen by people and often carried the biases of their time. Consider what stability meant to a lender in the early 20th century. A married man with a long-term job, a house, and established local connections might be treated as safe. A single woman, a migrant worker, a renter, or someone new to the city might be treated as uncertain, even with enough income to pay. The system rewarded people who resembled the lender's image of a reliable citizen. It punished many people for circumstances unrelated to their actual willingness to repay. The growth of automobiles intensified the demand for faster decisions. Car dealers and finance companies could not spend weeks collecting personal references for every buyer. They needed repeatable methods that clerks could use across many branches. Standardized applications asked for employment, salary, residence, bank accounts, debts, and references. The form turned a life into boxes before the computer turned those boxes into a score. Mortgage lending had its own systems of judgment. Banks, savings institutions, and federal housing programs evaluated the borrower, the property, and the neighborhood. Appraisal maps and underwriting rules helped institutionalize discrimination, particularly through redlining and racially restrictive practices. Creditworthiness was not assessed only as an individual quality. It was attached to geography and race, denying many families access to the loans that built wealth for others. After the Second World War, consumer credit grew rapidly. Returning service members formed households. Suburban development, automobile ownership, and mass-produced appliances increased demand for loans. Charge accounts and revolving credit became more common. A lender now faced more applications from more mobile consumers for more kinds of purchases. Manual judgment was becoming slow and expensive. At the same time, mathematics and computing were changing business. Statistical methods promised to identify patterns in repayment history more accurately than intuition. If past borrowers with certain characteristics had defaulted at particular rates, a new applicant could be compared with them. The loan officer's impression could be supplemented or replaced by a model. Bill Fair and Earl Isaac founded Fair, Isaac and Company in 1956. Their business applied predictive analytics to lending decisions. The central idea was powerful. Use statistically tested variables to estimate risk consistently. Instead of letting every branch manager invent a personal standard, a lender could apply the same model to thousands of applications. Scoring offered real advantages. It was faster. It could reduce the influence of a loan officer's mood or personal dislike. It allowed institutions to process large numbers of applications and price credit more precisely. It also made lending scalable. National credit card companies and banks could evaluate customers they would never meet. But a statistical system is not automatically fair. It learns from historical data, and historical data contains the structure of earlier discrimination. If a model uses variables closely connected to race, gender, or class, it can reproduce inequality while appearing neutral. Even when protected characteristics are excluded, other information can function as a proxy. The appearance of mathematical objectivity can make unfairness harder to see. By the 1960s, the consumer credit reporting industry was becoming more concentrated and technologically sophisticated. Files that once occupied drawers could be stored and searched electronically. Information moved faster across regions. A missed payment in one city could follow a borrower to another. This portability helped lenders, but errors could now spread farther and affect more decisions. Consumers often had little control over the files. They might not know which bureau supplied a report or what the report contained. An account belonging to someone with a similar name could appear in the wrong file. An old debt could be reported inaccurately. A disputed payment could look like refusal. When credit was denied, the person might receive no useful explanation. Public concern led to the Fair Credit Reporting Act of 1970. The law established important rights and responsibilities around consumer reports. It required reasonable procedures for accuracy, limited access to legitimate purposes, and gave consumers ways to learn about and dispute information. The law did not create the modern score, but it recognized that a private credit file had become powerful enough to require public rules. Other laws attacked specific forms of discrimination. The Equal Credit Opportunity Act of 1974 prohibited creditors from discriminating on grounds including sex and marital status, with protections later expanded. This was a major change for women, who had often encountered demands for a husband's signature, questions about pregnancy, or assumptions that their income was temporary. The legal system was beginning to separate credit risk from social expectations about who should control money. Now imagine a credit application from the years before those protections had matured. The paper is cream-colored, the type small, the questions arranged in neat rows: name, address, employer, salary, years at present residence, bank references, personal references, marital status, perhaps a place for the husband's information even when the wife is the applicant. Nothing on the page announces prejudice. It looks administrative, almost boring, but each blank reveals what the lender believes matters. This document is where the old system becomes visible. A question about years at one address treats mobility as risk. A question about a spouse assumes a particular household structure. A request for personal references transfers power to people in the applicant's social circle. A line for race or an indirect neighborhood marker can turn identity into a financial penalty. The form is not just collecting facts, it is defining the kind of person the institution considers normal. The application also shows why scoring became attractive. Two clerks could read the same answers and reach different conclusions. One might consider a 3-year job history stable, another might want 5, one might value a personal reference, another might distrust it. A numerical model promised consistency. The dream was that equal facts would produce equal decisions. During the 1970s and 1980s, credit bureaus expanded their databases while lenders adopted more scoring models. But there still was not one universal score used across the consumer economy. Different lenders had proprietary systems. A bank's model for a credit card might not match an automobile lender's model. Credit reports supplied information, while institutions interpreted that information in their own ways. The familiar turning point came in 1989, when Fair Isaac introduced the general-purpose FICO Credit Bureau score. It was designed to assess risk using information in a consumer's credit report and could be applied across lenders. The score did not immediately become the only measure in American lending, but it provided a common language. A borrower's history could now be summarized in a number that institutions recognized. The number changed the psychology of credit. Under the old local system, reputation belonged to a community. Under narrative reporting, reputation belonged to a file filled with observations. Under scoring, reputation appeared to belong to mathematics. A higher number meant lower estimated risk. A lower number could increase interest rates, reduce limits, or close access entirely. Mortgage markets accelerated adoption. In the 1990s, major housing finance institutions increasingly used credit scores in underwriting. Automation allowed applications to move more quickly through large systems. The score became important not only for whether someone received a loan, but also for the price of the loan. Risk-based pricing turned small numerical differences into thousands of dollars over time. The modern score is calculated from categories such as payment history, amounts owed, length of credit history, new credit, and the mix of accounts, though exact models are proprietary and evolve. It does not directly measure income, wealth, or moral character. It estimates the likelihood of repayment based on recorded credit behavior. That distinction matters. A person can be wealthy and have a thin score. A person can have modest income and an excellent history of paying obligations. Yet the score can feel like a moral grade because it affects so many parts of life. It can influence mortgages, car loans, credit cards, and sometimes rental or insurance decisions through related scoring systems. People speak of building, repairing, or damaging credit as if the number were a personal asset. An instrument created for lenders becomes part of the borrower's identity. This creates a paradox. To build a credit record, a person usually needs access to credit. Someone who avoids debt entirely may have too little information to score well. A young adult, recent immigrant, or person who has relied on cash can appear uncertain not because of missed payments, but because the system has little evidence. The model is strongest when it has data, so participation becomes almost compulsory. Scoring also changes responsibility. In the local system, a banker was visibly responsible for saying yes or no. In an automated system, employees can point to policy, data, or an algorithm. The decision feels impersonal, which can protect against favoritism, but also make accountability difficult. If the outcome is unfair, who is responsible? The bureau, the data furnisher, the lender, the model developer, or the law that permitted the system? Errors remain a serious issue because even a precise model produces a bad answer from bad data. A payment reported late by mistake can lower a score. Identity theft can create accounts the victim never opened. Medical debts or disputed charges can enter files in ways consumers struggle to correct. The Fair Credit Reporting Act provides dispute rights, but using those rights can require time, documentation, and persistence. The system has continued to evolve. Competing scoring models exist. Newer approaches explore rent, utilities, bank account cash flow, and other alternative data. Supporters argue that additional information can help people with thin files demonstrate responsibility. Critics warn that expanding data collection can bring surveillance into more areas of life and create new proxies for inequality. The question is no longer whether lenders will use data, they always have. The country store used memory. The mercantile agency used correspondence. The department store used local bureau files. The finance company used an application and point sheet. The modern bank uses national databases and statistical models. Each system collects a different version of the borrower, and each claims that its version predicts trust. What changed in 1989 was not the invention of financial judgment. It was the creation of a portable, widely recognized numerical language for that judgment. The score allowed credit to scale across a nation of strangers. It reduced some forms of personal bias and made decisions faster. It also concentrated enormous consequence inside systems most borrowers cannot fully inspect. That brings us back to the original question. How did people borrow before a universal credit score? They borrowed through reputation, collateral, references, local relationships, narrative reports, and lender-specific rules. Some benefited from flexibility and human understanding. Others were excluded by prejudice, secrecy, and arbitrary standards. The old system was not a lost age of personal trust. It was a system in which power was personal and often impossible to appeal. The modern score replaced that power with another kind. It is more consistent, more scalable, and in many ways more accountable to law. But it is also distant. The person behind the decision may never meet you, and the formula may never explain itself in ordinary language. A financial life becomes a pattern, and the pattern becomes a number. The small paper application from the middle of this story and the score displayed on a phone screen belong to the same history. Both ask who can be trusted with tomorrow's money. One hides judgment inside handwritten notes and social assumptions. The other hides judgment inside data and code. The technology changed. The central question did not. Credit has always been about more than borrowing. It is about who receives the benefit of doubt. It is about which past mistakes are remembered, which circumstances are forgiven, and which people are allowed to turn a promise into an opportunity. Before 1989, those decisions were scattered among thousands of human gatekeepers. Today, they can arrive in a second, wrapped in the authority of a three-digit number. And that may be the most surprising part of the entire story. America did not move from judgment to objectivity. It moved from one architecture of judgment to another. The old architecture knew your neighbors. The new architecture knows your accounts. Both can open doors. Both can close them. And both reveal that the real power in a credit system belongs to whoever gets to define what trust looks like. The next time a score changes after a balance is reported or an old account disappears, it is worth remembering how young this arrangement is. Millions of borrowers lived entire financial lives without a shared number, just as future borrowers may live under systems that look very different from ours. Credit scoring is not a law of nature. It is a tool built to solve the problem of trust at scale. Its history reminds us that tools inherit choices, and choices can be questioned, measured, and changed.